All right, we're live.
All right. Hey, everyone, and welcome to today's talk on all things derivatives and DEXs. Derivatives have proven to be a crucial piece of infrastructure for supporting the long-term growth of any asset class. Today, we have a star-studded panel of guest speakers that includes Yan-Wen from Perpetual Protocol, Barney from Vega Protocol, Antonio from dYdX, and Eric from Injective. Thank you all for being here today. Before we start our panel, let's just go around and have everyone introduce themselves and give a little bit of background information. We'll start with Yan-Wen, then Barney, Antonio, and Eric.
Hi, everyone. I'm Yan-Wen. I'm the co-founder of Perpetual Protocol. Perpetual Protocol is a decentralized perpetual contract platform and with AMM. So you can actually think we are actually like BMax or FTX with Uniswap. The protocol has been live for over 7 months now, and I think we are doing very good on the trading volume wise. I think we have like totally over 20 billion on the trading volume. So if you guys are interested in Perpetual Protocol, our website is perp.fi. So yeah, thanks for having me here.
Awesome. Hi everyone, I'm Barney, co-founder of Vega Protocol. Vega is a derivatives protocol that is a sort of hybrid layer 1, layer 2, if you like. It runs its own network for high performance derivatives and other trading. It's designed with sort of real world use cases in mind. We've been in testnet since the beginning of 2020, and we will be launching the first restricted mainnet soon in the next few months. And if you're interested in getting involved, hop on over to vega.xyz and check out our Discord and forums and Twitter.
Hey guys, I'm Antonio, the founder of dYdX. dYdX has been around for about 4 years now and live on mainnet for the past 3 years, currently focusing also on perpetual contracts trading with up to 25x leverage. We run on order books instead of AMMs, so kind of a different design choice than perpetual and some others there. But we do that kind of for increased performance and more advanced trading features. Currently live on layer 2 in partnership with Starkware on a zero knowledge rollup based layer 2 system.
Hey everyone, I'm Eric Chen, CEO and co-founder of Injective Labs. Before Injective, I was a researcher at a hedge fund working on trading strategies and protocol research, and also was part of a University Blockchain Lab working quite a few cryptographic research. Injective Labs started off back in 2018 on research around candidates and applications for verifiable delay function and focus on utilizing verifiable delay function to solve front-running and transaction collision. It eventually turned into building and exploring scaling solutions for consensus designed for all things exchange related and serving the greater Injective community on perpetual swaps, futures, expiry futures, and general exchange infrastructure.
Thanks, everyone. Let's kick things off with a question for the entire room. A big debate within the crypto sphere is the battle between sexes and DEXs. On the one hand, you have centralized giants, and on the other, you have decentralized newcomers such as yourselves. What do you believe to be the future of crypto? Can sexes and DEXs coexist, or do you think that one segment will eventually take over? Let's start with Antonio this time, then Barney, Yan-Wen, and Eric.
Sure. I mean, I think they already are coexisting. Obviously, centralized exchanges still are quite a bit bigger for the most part than decentralized exchanges as trading volume goes. But I think a lot of people can sort of see the writing on the wall in terms of how more volume is moving from centralized exchanges to decentralized exchanges over time. Very much open for discussion what the end state of things is. But personally, I think that most crypto to crypto trading on some time horizon will happen on decentralized exchanges rather than centralized exchanges. I'm sure we can all speak to this and probably all agree on it, but there are quite a lot of advantages for trading crypto and especially more advanced financial products on crypto on decentralized exchanges. It's a much more secure way to trade. You can hold your own keys. It's much more transparent. You know, none of us are saying, hey, trust us, we are not going to steal your money. It's like, no, instead, just look at the smart contract code. A lot of these protocols, and at least what we're building towards at dYdX, is that they are fully decentralized. They're just open source code that's running on the blockchain that makes them available in more places. So I think there are a lot of advantages. And I guess to directly answer the question, I do feel like most of the trading volume on kind of a 5 to 10 year time horizon will be on decentralized exchanges. There are a lot of hurdles to overcome before we get there, I think. So, decentralized exchanges and especially derivatives exchanges are just fundamentally pretty complicated from a technological perspective, though I think there have been quite a lot of improvements made by all teams present and others, especially in the past year or so. And then it's also always just kind of hard to build up a two-sided marketplace from zero. But I think there are a lot of great people working on the problem now, and I expect really big things in the next few years.
Yeah, I'd agree with a lot of what Antonio said there. I think the way I tend to think of this is that the decentralized exchanges and protocols are kind of the infrastructure layer, and the default infrastructure of the future will be open. It'll be decentralized. It'll be sort of open sourced. It'll be community driven and free for people to use and interact and innovate on. And so I think over time, as Antonio said, there are some hurdles, and for each product and for each user type, there are different hurdles presented. And as we kind of knock those hurdles down, we'll see more and more volume move over that sort of 5-10 year horizon onto decentralized exchanges. But I think there's probably always going to be a room for sort of sexes and centralized exchanges in kind of niches. And the niche could be a certain industry, it could be a certain group of sort of very significant institutional participants, it could be certain jurisdictional regulatory reasons. So I think you'll always see centralized exchanges pop up. They're easy to create. They're fast, they serve a purpose, but I think you sort of imagine that happening with the base layer being the crypto infrastructure that's open and decentralized, where that provides the base. And then on top of that, you get centralized exchanges popping up where it makes sense and where it's useful to do so.
Yeah, actually, I agree with Bonnie that I actually don't know, I wish that centralized exchange can go away faster. But to be honest, they are still there. FKS Binance are still doing pretty well. So I think that maybe they will centralized and decentralized exchange will coexist in the future. And I think most of the protocol, but I think centralized exchange will integrate with most of the protocol that we have right now, like Uniswap, the protocol we have here, and provide liquidity to the centralized exchange, and then it kind of become the backbone, like Bonnie said that.
Yeah, I think from a historical perspective, centralized exchanges really was the pusher and the usher behind the entire boom around cryptocurrency. So basically, when the users first get in touch with the crypto space, first buying their first Bitcoin or buying their first Ethereum, that's always going to be done on CEXes. And the fiat gateway definitely is basically the opener for this entire crypto ecosystem that they're about to explore. So I think there's a very strong symbiotic relationship that allows for coexistence. And as a matter of fact, in terms of the workings and interoperabilities of existing CEXes and DEXs, we already see that happening. For example, AMM models like Perpetual Protocol or Uniswap, they rely on LPing and basically arbitraging to create this active and accurate price feed, right? So and the global liquidity is tapped from CEXes, and hopefully eventually towards tap from other order book based or other dynamic DEXs. But right now we see this very strong coexistence. For Injective's case, it's definitely a very interesting relationship, considering Injective has a standard order book model. So that means that it's very similar in terms of trading experience and the trading model as centralized exchanges. But interestingly enough, a lot of our major backers are major exchanges, contributing to more than half of the global volume in spots and derivatives. And they've placed their faith in us, basically their decentralized counterpart. So it shows that basically it is a coexistence and symbiotic relationship, and they also confirmed that. I think over time, we realized that CEXes can't meet all the demand of all the users. There's going to be niches that pop up. There's going to be interesting use case and interesting markets that CEXes can't adopt or they can't explore. And this is where DEXs come in and grow and really take over some of the market shares and also the market models, and basically create a very, very significant share in the global volume over the next 5 to 10 year horizon.
Thanks, everybody. Now we'll get into some individual questions. Yinwen, congratulations on the announcement of Perpetual Protocol V2 Curie. Could you explain how the VAMM exchange model works, and what are the fundamental differences between V1 and V2?
Sure, that's a good question. So, Perpetual Protocol is built on virtual AMM concept. So we are actually the first one to introduce this concept. So all the token is not, it's not ERC20 token, it's not a real token. We actually have virtual asset, mint by the contract, and then we place those virtual asset onto, other AMM like Uniswap V2 or V3. So it actually have been working quite well for the past few months, but we actually, spend a lot of time, trying to, have a new version on this. So for our V2, I think there are like 3 features that we really want to, introduce. The first one is the concentrated liquidity. So on our Perpetual V1, we are actually using the XYK model as our AM, so which is really not very capital efficient. But with V2, we are actually using Uniswap V3 as our pricing engine. So it actually bring all the nice thing from Uniswap V3, concentrated liquidity, and we can have like limit order. So that's really great. So that's definitely the first thing that we want to introduce. The second thing that we want to introduce is actually permissionless market creation. So traditionally, AMM, the good thing about AMM is that it's much easier to bootstrap the market. But in Perpetual V1, we still have a vote to kind of like governance has to vote to create a new market, like a new uni market or a new curve market. But with V2, we actually want to open this up to everyone. So anyone who want to kind of like provide a security for this market, then they, he or she can create that market and then people can trade on that market. We think that this is a really cool feature. The third thing that we want to do is that we want to catch up the usability of the centralized change. So, so Perpetual Protocol, V1 is actually kind of like basic. So we don't really have a lot of feature that centralized exchange provide, like FTX. So, for example, like we run a Sky is really not that fast, but for V2 we'll be running on Arbitrum. So I think that will be much. The bandwidth will be much larger, and then it will be much faster. The second thing is that we will have close margin. I think dYdX actually explored this like long before, so I think that's a really neat feature for us to really compete with centralized change. The third thing is like we want to accept non-USD collateral. So right now on V1 we only accept USDC, but in the future we want to actually accept like ETH, WBTC or other ERC20 token. Yeah, so that's just a overview like what we are going to introduce in V2.
Great, thanks for that overview, Yinwen. Antonio, it's been great to see the growth of dYdX. dYdX processed over 3 billion in total trading volumes on your layer 2 protocol. As a decentralized trading service provider, what do you think are the users' top needs and expectations from you? And which of those needs are you choosing to prioritize at this time?
Yeah, well, we're definitely targeting more sort of prosumers as crypto traders go. I think the big growth strategy that we've been trying to execute on has been moving over more traders from centralized derivatives exchanges, places like Binance, FTX, et cetera, over to decentralized exchanges over time. I think Yinwen touched on this in his answer as well. But I think a big thing all of us, and especially dYdX, has been working on in the past year has just been building really great user experiences that we're targeting to be on par and in some ways superior to centralized exchanges. For us at dYdX, that's supporting things like limit orders, stop loss orders, trailing stops, like all these advanced statistics that users want to see on their positions. With Starkware, we're able to support just zero latency trading on the exchange, so it feels as fast as trading on a centralized exchange. And that's really just been a big focus for us on the user experience side. In terms of the types of products that users are trading in the derivative space right now in crypto, it's really dominated by perpetuals. I haven't looked at the numbers exactly in a little while, But last I looked, I think perpetuals were trading roughly like 100 times the volume of all the rest of the types of derivatives on crypto combined. So it's really kind of required if you want to, I think, play in the derivative space in a big way right now to support perpetuals contracts trading. So it's sort of a no-brainer. On the product side, one of the other things we've been focusing on is launching a lot of new markets on dYdX. Yan touched on this as a priority as well. But we've launched, I think, like 25 markets or so on a pace of adding one new market per week, which is getting more competitive with centralized exchanges. And then users also, one of the other kind of subtle but really important things that Yan also touched on that we also support at dYdX is kind of this concept of cross-margining. For those that aren't aware, what cross-margining is you can use one margin account to collateralize all the different markets you might want to trade on dYdX or whatever other platform you're trading on. This is super important from a capital efficiency perspective. It's also super important for capital efficiency for market makers on dYdX. So that was a super critical feature that we had built into our layer 2 and exchange, and that's live now, and then just continuing to iterate from here.
Great, thank you. Eric, Injective has been working on the development of the mainnet Canary chain. It's been really exciting to see the rising community engagement involved with that and the launch of initial spot markets. Can you explain what's next on your roadmap and how you plan to carry out the release of perpetual swaps and expiry futures?
Yeah, so for our next step, Injective will obviously be unlocking expiry, perpetual swaps, and other types of derivatives, and as well as very robust testing around them. We'll also be working on multiple Oracle integrations beyond on what's already set up on the initial genesis of the mainnet Canary chain. So there's a lot of exciting developments around that. One interesting thing that we're working on is expiry futures is not too common in the current DeFi space. And one thing that we definitely want to usher and definitely want to extend and put more use on is the kind of like this propagation of more usage of expiry futures. For example, tokenizing it, turning it into a exportable position that can be traded elsewhere. And that's something we're really looking forward for the community to explore and utilize as well. After this, we will soon see the release of the final phase of mainnet canonical chain. So the canonical chain will function exactly the same way as the Canary chain, but without any type of testing style limitations. For example, currently on a Canary chain, you can't deposit more than $50 from the Injective Labs front end. And the canonical chain will obviously include any type of unrestricted trading for a plethora of new markets with full-fledged governance capability. So that means that any community members can vote on and propose any type of markets. And currently, we've already tested a lot with the spot market and eventually towards the derivative market to proposing and generalizing any type of market creation process on Injective.
Thanks, Eric. Barney, Vega has been working on the development of the mainnet and recently launched the incentivized testnet. Can you tell us a bit more about how this is preparing you for the next steps in Vega's journey?
Absolutely. So when we think about Vega, we are actively doing two things in parallel to bring the network into life. And the first one of those is to thoroughly test and put through its paces the protocol itself, and that's from a sort of economic point of view, from a risk point of view, from a trading point of view, capital efficiency, and everything else. And that's the job of the incentivized testnet. And the second thing is to effectively to bring the proof of stake network into existence and have that up and running well and be secure and be operating well. And you asked about the incentivized testnet there, and really what we've been doing in that is we've started off by sort of working with prominent people in the space, with our community, to sort of build things, develop on the incentivized testnet, create markets, test out the liquidity protocol, test out permissionless market creation, test out the sort of the leverage features, the margin control features that are all fully decentralized. The incentivized testnet pushes that a step further, because one of the huge problems with testing a sort of economic protocol in a testnet is that people are not incentivized to do the same things when there's no money at stake, and when it's sort of just a test network. They will mess around, they'll throw stuff at it, but they're not really worried about their money. So what we've done is defined a series of tests which incentivize different activities and incentivize groups of people to behave like they would in a mainnet scenario. We've recently completed the first one of those, and actually just by incentivizing people to try different things and make money in a sort of trading competition. We identified a critical bug that just didn't turn up in any of the kind of testing we did with many sort of hundreds of community members before we did that. And so we've sort of incentivized about 600 people in that first sort of round of testing, and there's a whole bunch more coming. So we're actually going to be doing a bunch of things in parallel and sort of rolling out a whole new set of tests over the coming months, probably actually in parallel even with the mainnet release, because we think that there's probably value in sort of running a test sort of, a sandbox environment where we incentivize people to do weird stuff and help us find it before it gets found in mainnet. So, both as we prepare for mainnet and even afterwards, as we hone the features, we're going to see more and more incentivized testing, and we hope to reward the community to be a big part of that and to help us find the bugs, help us improve the protocol, and help us make sure it's useful for real traders. Because really, the only way if it's useful is you actually try it out.
Great. Now a question for the entire room. Perpetual, Vega, dYdX, and Injective were all made possible because of their unique scaling solutions. As there are different approaches to building a layer 2 scaling solution, what is yours and what makes it unique? Let's start with Yenwen, then Eric, Antonio, and Barney.
Sure. I think we actually are the most general one. So we actually use SDI right now. So just a public blockchain sidechain solution. For us, we don't really go down that route. I mean, like building our own blockchain, or like having picked like more like high bandwidth one. Is because we do think that the composability is really important for us. So being on Sky definitely is like trying to like work together with other DeFi projects. But to be honest, there are not many DeFi projects on Sky. So on our V2, we are actually going to build on top of Arbitrum. So hopefully, there will be like more like DeFi projects on Arbitrum, and then so we can integrate with others. But bandwidth wise, I think even on like new layer 2 like Arbitrum, I think it's still cannot like it's not comparable to like like a customized solution like Injective or like Vega are building. So yeah, but I think that's just a trade-off on us. Yeah.
Yeah, so for Injective's case, we built on top of Cosmos and actually created a lot of different interesting modules from our base layer infrastructure to make it maximum compatibility, while kind of also focusing on efficiency and the trading speed. One thing that's very surprising for us when we were running our Solstice testnet is the amount of usage and the amount of bandwidth that's required to run the entire protocol. So when we were testing Solstice testnet, we saw kind of almost like every month there's 10,000 new users coming on, placing trades, placing a lot of transactions. And basically, we actually had to revamp the EVM module so that we move off the derivative layer from the EVM, basically a smart contracts-based architecture, towards a more bare-bone Cosmos-based architecture. So basically, where it stands right now, Injective has several main components. One is the exchange and derivatives module. And so that kind of enforces the settlement, the trading, and also the matching of the entire protocol. And we also integrated with frequent batch auction, and this way to remove any type of collision and front running issues, along with soft cancel, which makes it an extremely friendly environment for market makers. On top of that, we also retained the EVM module for any type of generalized scaling solution for any Ethereum, dApps, and DeFi protocols to be composable with the derivative and DEX layer. But that being said, what's really stands out for Injective is that it's an application-specific scaling solution for derivatives and order book exchanges. The bespoke infrastructure overall is kind of tailored specifically for the exchange and derivative market trading. So the entire ecosystem and for any type of future potential for scalability and upgrades is centered around this order book infrastructure and the settlement of derivatives. So this kind of creates this alignment of incentive for the entire Injective community to not be boggled down with usage of other tools or usage of other projects, and rather just focus on how to best optimize the order book infrastructure. But in terms of from like an average user or from like a consumer perspective, one really cool thing about Injective is that there's no gas fee whatsoever. It's subsidized by the relayers from kind of like a baked in incentive system. And overall, you also have that composability with other DeFi projects that are trying to move from Ethereum onto Injective. And another cool thing is that we have IBC. So that means that there's a very secure layer of data transfer and also asset transfer between all the Cosmos-based projects that are IBC compatible. And that's actually one of the interesting things we're working with Ben right now, is to be one of the first projects to be integrating with them through the IBC layer rather than the Oracle layer. And the last part is obviously we have a pretty fast block time.
So for dYdX, we're built on top of an Ethereum-based layer 2 rollup system called Starkware. Starkware is one of the pioneers in kind of a new area of scaling technologies called zero-knowledge rollups. Basically, the way these zero-knowledge rollups work is you have some amount of computation that you want to do, which, say on dYdX's case, is all the trades you might want to execute on dYdX. You can do what's called a zero-knowledge proof, which is sort of this new area of cryptography, but you can effectively prove that all of the trades in this batch of trades that dYdX wants to execute are valid. You know, maybe that all the accounts are collateralized after the batch of trades, maybe that all of the trades have valid signatures, et cetera. And the cool thing that you get out of this zero knowledge proof is kind of this constant size data object, which is the proof. And this is where all the scalability comes from, because of this zero knowledge proving is all done off chain. It means that you can only put this very small proof object on whatever chain you're building on top of, which for us is Ethereum. And that's where all the scalability comes from. So building on top of Starkware is super scalable, more so than sort of optimistic rollups. It also allows us to offer, like I said, really instant and kind of fast trading, which is super important from a user experience perspective, while maintaining maximum decentralization, because sort of zero knowledge rollups effectively inherit all of the decentralization and security guarantees of Ethereum itself, with sort of this new cryptography built on top. So that's why we partnered with Starkware. Like I said, we've already been live on top of Starkware for about 4 or 5 months now, and then continuing to build out new features on top of that.
Yeah, and so very interesting actually listening to Eric talking about Injective, because I think there's a number of similar design decisions made when it comes to scaling, you know, that are sort of common across Injective and Vega. And you know, we came to the same conclusion, which is that to scale and optimize derivatives and trading, you really need to build systems that optimize for derivatives and for trading. And you know, I worked in traditional finance and building exchanges and trading platforms in the past. And you know, in every case that I saw, you would never use off the shelf kind of, you know, web frameworks or application environments. You would really build sort of highly optimized infrastructure for those purposes. And that was something we did from day one. We built Vega on top of the sort of Tendermint, which is part of Cosmos. When we started building Vega, the Cosmos SDK wasn't really a thing, and there were less pieces. So we built, you know, things like the sort of Ethereum bridge from scratch ourselves, which gives us a few UX advantages, but obviously takes a little bit more time. We also look at scaling in 2 ways. So the first way to think about scaling is, let's say I have a network, how many transactions can I do? How fast is latency on that network? And we want to optimize for that. And the Tendermint protocol gives us a great, you know, fast block time, so relatively low latency for a decentralized platform and large number of transactions. And certainly for the foreseeable future, we'll be on that. But we sort of have a sort of modular design, which means that the kind of the business logic modules that sit on top of the blockchain in Vega, you know, they provide services like settlement, margins and valuation, product execution engines, and all of that, and oracles, and that they could be moved to another blockchain if we came across something faster. The other type of scalability is the kind of horizontal scalability, which is saying, well, eventually we may want hundreds or thousands of markets run by the community, and you may get sort of clogged up. And one of the great things about markets is that if you look at sharding in a general purpose blockchain, it's really difficult because everything might want to know about the state of everything else, and any contract might care about the state of another contract. So you have this kind of really general purpose computing problem with explosions of number of, you know, connections between chains and shards, and things get really difficult really quickly. But when you're talking about markets, the state of an order book on a market is really kind of independent of the state of the other order books. And so, you may need to sync up balances every so often, but actually you can quite easily design a system that is quite, exceptionally shardable and scalable in terms of running multiple networks in parallel. And so the advantage of this scaling solution, where we design a scalable derivatives and trading protocol on top of a proof of stake chain, is that we can effectively make that shardable into tens or hundreds of networks, each with the same capacity of the first one, and each running different subsets of markets with, much lower overhead and much lower complexity and much lower security consideration in terms of new features and sort of cryptography to sync state between them than you'd have to do for general purpose smart contracts. So that's been a big consideration in the design. And in general, I think that's what we're looking at is because you're sort of an application specific chain, your ability to optimize and to iterate really fast, to make things go faster, to make things better, and to serve the customers and users of that specific protocol is just much better than you would find if you're kind of on a chain that's dealing with 20, 30, 40 different use cases and different types of application. Examples like Eric's example of gas fees. We have no gas fees for placing orders. You pay fees when you take liquidity and trade, and those fees fund the running of the network. We have all of those kind of optimizations can be made because of those decisions.
Thanks, everybody. Antonio, could you tell us a little bit about the market creation process on dYdX? Do you plan on focusing on perpetual swaps or extending to other market types as well?
Yeah, we're pretty focused on perpetual contracts for the time being, and probably at least for the next year or so. Like I said, it's really just driven by market forces and kind of consumer demand. Just perpetual contracts, as I mentioned, have been trading about 100x the volume of more dated products like options and sort of dated futures on crypto, at least at this point. I don't think that'll last forever. I am excited about some of the growth we're seeing in the options market. That's being driven by Deribit, FTX, and others. So certainly tracking that. And I think probably like most of the people on this panel, I would expect see dYdX as not just an exchange for one type of derivative like perpetuals, but as a place where users can trade all types of advanced financial products and specifically derivatives. But for the time being, focused on perps, like I said. In terms of the markets that we're launching for perpetual contracts, mostly just focused on a combination of the top like 10 to 20 markets with sort of a DeFi focus, because obviously users of dYdX are using DeFi, so they're probably more interested in like Ethereum and DeFi coins. ETH is by far our biggest market, with sort of Bitcoin doing about half the volume on dYdX. And then we have sort of a long tail of markets that we support after that.
Eric, Injective allows users to access unlimited markets on its custom protocol for cross-chain derivatives trading. This means that users can create any market. Can you explain more about how markets are created on your protocol and how it's currently governed?
So the Injective Governance module is actually highly flexible, and basically the underlying parameter for every single futures protocol, or basically perpetual expiry futures and other types of derivatives, it's all customizable, and basically the user or the market creator can specify the parameter in any way they see fit. So Injective Labs actually built a graphic interface for some of the simple market creation to really turn this into a community-driven effort and to really democratize the process for creating a derivatives market. Obviously, the users can create much more complex markets through the Injective node. And during the Solstice phase, we've actually tested out a kind of plethora of different types of derivatives. For example, yield farming derivatives, expiry futures on stocks, and also different types of perpetual swaps, and some of the really interesting kind of Forex futures, and also basically synthetic commodities. So this is something that we expect the users to really explore and to leverage heavily over time, especially as the Injective community grows, kind of beyond just a more consumer based, but rather towards a more professional and institutional based platform for any type of derivatives trading. Another really interesting part is that the way the Cosmos governance model that we inherited, no one really holds any exclusive authority over the governance process. It requires a deposit, it requires to reach quorum, and basically any type of governance vote requires the key stakeholders to kind of participate in the governance and to delegate the vote or actively participate. And this is really what we're looking for, is the long-term growth of Injective community to be rested on those who actually stake into the proof of stake consensus or basically participate in any type of governance model for a long-term success.
And when some of the other attendees today are building order book-based exchanges, however, Perpetual is focusing on bringing Perpetuals to an AMM model. Can you tell us a little bit more about this approach and your focus specifically on AMMs?
Sure, this is a good question. I mean, the team is actually a big believer of AMM. So I think, seeing like the growth of Uniswap and also other like Curve and Balancer, all this AMM, actually, I think that's really something that's special in the DeFi, ecosystem. So I think that's the thing that we really want to do. Like I said before, AMM actually, I think, make it easier for us to kind of like bootstrap the market, kind of like provide the liquidity, but at the same time, it's not as efficient as Order book. But in our like new model, like Perpetual V2, we actually using Uniswap V3. So Uniswap V3, they actually have this like really interesting concept that kind of combine a traditional AMM that they kind of like invent, and then with the order book. So right now you can actually place the liquidity, within a range that you want. So it actually kind of like bring the AMM much closer to the order book. So it's actually more capital efficient in that way. So so I think that AMM, being like 2 or 3 years, that the AMM actually has a lot of progress, but I think Uniswap V3 actually bring another kind of like new innovation to the whole AMM ecosystem. So I think right now we should be able to build a perpetual AMM that's as efficient as order book. So yes, I'm kind of like really excited that want to launch this V2 as soon as possible. Yeah.
Barney, Vega's mission is to create decentralized trading infrastructure that can operate professional-grade markets. Decentralized trading markets introduced a number of new challenges for consensus protocols, such as attempts of front-running, rushing, or denial of service. I know Vega is working on solutions to these issues, so could you tell us a little bit more about that?
Yeah, absolutely. Obviously, front-running is a huge deal, and MEV is a massive topic today in the Ethereum community, and it's something that in my mind and in the minds of sort of many people, I think has to be solved properly in order to see real world adoption of sort of crypto and decentralized protocols for trading. Perhaps outside of the sort of DeFi space, which at the moment is kind of maybe a bit of a special case there, perhaps. But what we've actually done some original research. Our researcher Klaus Kasawi, who's been sort of in the blockchain space for a very, very long time, even sort of working on consensus before Bitcoin in the sort of consensus algorithms space, has come up with an algorithm called Wendy, which is effectively an algorithm that guarantees ordering in a consensus layer. And effectively what we do is, rather than using sort of a fee bid to order transactions, we actually use the Wendy algorithm, which effectively says that in the same way that you include transactions based on a quorum of sort of honest nodes, being trusted, trusting that there are at least 2/3 plus one honest nodes, but same way you include transactions based on that quorum, you also use that sort of same trust model to say, well, at the nodes, if 2/3 plus one of the nodes are honest, then if they saw transaction A before transaction B, then it will be scheduled before transaction B. So that effectively means that under the same assumptions we make for a proof of stake network in general, we can say that transactions will be scheduled kind of in the order they occur, and that someone can't come in partway through a block having looked at the mempool and and take advantage of other people's the information about other people's order flow or other people's transactions. So we think this is going to be a huge deal, and we think whether it's Wendy or whether it's alternatives like Commit and Reveal, we think every blockchain that carries significant sort of decentralized trading in the future will need a solution to this problem. That's a big one we've solved. And then the other problem I think, that we've solved or are working on solving particularly is sort of the trade-off between order books and their ability to disclose and determine good high quality prices and to avoid things like impermanent loss, and AMMs and their ability to capture liquidity and provide liquidity to perhaps smaller markets and early on in a market's life, and to provide bootstrapping. And it's very interesting that our solution to this is probably, I think our solution and the Uniswap solution will probably converge, but from different approaches. So Uniswap have started with an AMM and gradually turned it into something that can also be an order book. What we've done is started with an order book and gradually turning it into something that can also be an AMM. So effectively what we will allow is hybrid order books where if there are, you don't have to have limit orders on the book, you can provide ranges or pooled liquidity to the book, and effectively the protocol will then sort of allocate to orders that come in. It'll allocate liquidity either from the sort of pooled liquidity or from the limit orders based on which one's going to give the best price at that point in time. And effectively that allows you to bootstrap markets and bootstrap networks and provide liquidity in a pooled form with very minimal overhead, with no active traders and no active pricing. But it also allows a market that becomes super liquid and a market that becomes highly competitive to have liquidity provided by active pricing of limit orders. And so really, we think that solution where you have the hybrid form and you can take the best of both worlds and allow a market to kind of sort of automatically decide how much AMM liquidity and how much limit order liquidity is going to be taken is going to be the future for this.
Now, another question for everybody. Throughout this explosion of DeFi protocols, we've seen a number of projects come and fizzle out pretty quickly. However, everyone on this panel today has sizable communities that continue to grow on a daily basis. What steps have you guys taken to achieve your success so far, and how do you plan on continuing to spur future growth? We'll start with Yenwen, Barney, Antonio, and Eric.
Yeah, that's a great question. I think we are actually lucky. So we launched. The project actually launched earlier, before the whole EO farming craziness. So we actually kind of have a group of community member that with us for a long time from the beginning. So I think that I don't know how to replicate this now, but we do have this core member that's really give us lots of suggestions, and they talk about lots of different ideas that we should implement. So personally, I think that trying to find the core community or from your community and try to, at least for our community, I think they want to see our progress. They want to see the product. So we actually just kind of building a product. We actually have a channel that kind of weekly kind of news from the team, and then what's the feature we shipped. So I think that it depends on the community, but at least for us, this actually help. To bring people together, and then people want to see the progress. Like a kind of public dashboard, all the things that just try to be more transparent to the community. I think that definitely helps.
I think we, sort of similar to Yenwen, one of the key things is that sort of those deep sort of early people. And, I sort of see three things that we do to keep, maintain, and grow a community. And the first one is that deep base, and it's having people, and we see this across a number of adjacent communities. The sort of the research community is very important to us. And so not only doing our own research in a bubble, but working with academics, working with other projects, working with people who are doing research in the space, publishing that research, engaging with it in conferences and online. That's super important to us. Engaging with the sort of the VC and thought leader and crypto Twitter space, and making sure that people who are thinking about this stuff every day and researching and getting involved are also supported and people we look after and people we talk to. And then obviously the trading community and the DeFi community and the crypto users and the crypto community at large. So that sort of deepness is the first one. Then the second one, I think, is the transparency and engagement. So, again, I think Yenwen made a similar point, which is if you share what you're doing, if you engage with people, if you help them, if you talk to them, they start to like you, they start to trust you, and they start to tell people and get them involved. And that's super important to us. And then the third one, which is obvious, is the more mercenary, the sort of incentivization. The community needs to have a reason to be around, and it may be that simply the incentive of using Vega for what they're interested in doing and seeing it as a great solution, but also it can be the incentives of how they can get something they want, whether that's a community, whether that's payment for bounties or grants or getting involved, or whether that's potentially being a liquidity provider in future. Giving them that idea of what they're getting out of the community as well as what they're putting in helps to keep people around for a long time.
For dYdX, the biggest thing that we focused on has always just been the product. We've gone through a lot of different product iterations on dYdX, launched a lot of things from a lending protocol to margin trading to spot trading. And now, like I said, really focused on just perpetuals contracts. But I think just continuing to ship out these, at least what we think are high quality products, and iterate on them, with community and our users' feedback is super important. Just historically, like that's the way we've seen all tech companies grow, is you launch a product, has some niche, has some early adopters, it's not perfect, then you iterate on it, build like the next thing. And I think just being able to continually ship and iterate has been the main driver for growth for dYdX so far. And I like to think, has given us one of the best product experiences in the space, just because we're always super laser focused on building the best possible product on production that we can.
Yeah, for Injective's case, it's definitely a very active approach in community building. So Injective has grown to over 100K members across all channels, and the entire community driven efforts have created this kind of incentive structure and incentive design so that it sustains itself throughout a kind of a long-term positive feedback loop of growth. The way we initially went about building out this protocol and kind of this incentive design is so that everyone has ownership over the protocol. And this is pretty evident for Injective's launch and for Injective's design of relayers and the allocation of fees to relayers so that these relayers can, over time, create this revenue and create this kind of flow of tokens to continuously iterate its own product and to iterate for a more friendly user environment. And overall, I think instead of focusing on product for dYdX's case, Injective is more focused on building out the base layer infrastructure and building out an efficient environment for derivatives trading and for spot trading so that over time, this community evolves itself and building out this blossoming kind of ecosystem of projects that has the chance to focus on the product. And I think, for us, at least this is the approach to go for, because Injective acts as a base layer of infrastructure and kind of creating this incentive for everyone to join in and grow the community in a more agent-based way.
Antonio, can you explain how zero knowledge or ZK proofs are utilized in your Starkware solution? And could you start just by explaining ZK proofs again in a nutshell?
Yeah, absolutely. So zero knowledge proofs, as I was going to mentioning before, are a way you can transform any sort of computation that you might want to do off chain and verify that it happened on chain, but just by putting a very small proof on chain. So again, like with the way dYdX uses zero knowledge proofs with our partner Starkware, is we have a bunch of trades, maybe a bunch of liquidations, deposits, withdrawals, like all the state changing actions that may happen on an exchange like dYdX. And then we batch all these actions up. Currently we batch them up once every 8 hours. So we'll take this batch of everything that's happened on dYdX, and now we want to commit it to the blockchain, back to Ethereum, basically. We don't commit like this entire long list of trades back to the blockchain because that would be super expensive. So what we do instead is we run a zero knowledge proof that effectively proves all these things that users have done on dYdX are valid. And then what we get out of this is just this really small kind of constant size data object. And then that data object is the only thing that goes on the blockchain. And that's where all the scalability comes from. Constant size, what that means is it doesn't matter how many trades go into this batch. Could be 1, could be 1,000, could be 1,000,000. The proof size is still always the same. And that's really kind of the core innovation of zero knowledge proofs and zero knowledge rollups, and where all the scalability comes from. Because we're only putting effectively the proof and sort of all of the data that's changed on the blockchain rather than every individual trade. And that's led to about an order of like 100x scalability improvement over what we were previously doing on layer 1 Ethereum. And I think that's only going to continue to improve from here.
Eric, given Injective's vision for interoperability, can you tell us your plans to bridge across other popular chains such as BSC or Polygon? I know you were built using the Cosmos SDK, so what role does that play in achieving this goal of becoming cross-chain?
Yeah, so the most interesting part about Injective is that it's IBC ready on day one. So that means that basically for any type of other IBC compatible layer ones, such as, Band soon, or let's say Terra, that's going to be enabling IBC pretty soon as well. And, the overall core Cosmos ecosystem like Gravity DEX and other, Cosmos zones, those can all always be enabled and kind of interop in both data and also assets in an extremely seamless way. And I think there's a lot of creative ways to utilize IBC to make sure that basically any type of composability and also any type of data that's being transferred between chains can maximize its composability with different types of modules and also different types of, I would say, VMs. In terms of integrating with other popular chains like BSC or Polygon, there's actually a very funny story behind Polygon. My co-founder Albert went to India for a couple of months actually to work on the integration with back then it was Matic. And so we definitely have a very strong conviction around integrating with Polygon and bridging over this unique ecosystem of DeFi projects on top of Polygon. Obviously, Sandeep is also an investor and a good friend, so we're looking forward to ushering a bridge out very soon. And so in terms of BSC, it's actually very straightforward for Injective's case, just given our relationship with Binance and BSC's native EVM compatibility. So that makes it extremely easy for us to deploy some sort of bridge contract or some sort of kind of like a POA system, so that it's an extremely seamless asset transfer. So generally I would say Injective Labs' role is to create these suite of tools and these kind of ecosystem of bridges so that it will be included in governance vote. People can decide whether these bridges should be included within the Injective ecosystem, and really let the community decide, which chain to integrate with and which chain to work on later.
Barney, Vega has designed an automated process for creating markets on and trading margin derivatives. This means that potentially users can launch any market. Could you tell us how markets are created on Vega Protocol and how this will be governed?
Yeah, absolutely. So a sort of core part of the Vega Protocol, and I think something similar that Eric said about Injective, is the idea that we're building infrastructure really for people to create markets and to create derivatives products. And one of the key things about building infrastructure is you need to make sure that the people who use the infrastructure, can get something useful and can get what they need out of it. And in the case of Ethereum, for instance, people being able to go and create their own tokens and make projects out of them and have complete sort of control over that, enabled a huge ecosystem of projects which themselves could become profitable or sustaining in terms of the economics. And we think of a similar thing in terms of Vega. Like there's a great economic case for launching markets that are in demand on Vega, and the people who launch those markets and supply early liquidity will actually receive more in terms of rewards from the protocol than people who join large successful markets later. So there's really kind of a sort of engine of growth built into the protocol around creating a business case for creating markets and going off into the community and publicizing those markets, I guess. So the protocol sort of enables you to propose a market. We went for the sort of proposal and governance method because if you look at Uniswap now, it's possible to kind of create a market with between any two tokens if you know the addresses and go and find that and do that in the protocol. And even there, we see people creating sort of fraudulent tokens and saying this is this token, this is the other, and trying to scam people out of money. This problem is even worse with derivatives because it's fraudulent oracles. And when you look at an oracle that hasn't provided any data, you can be in a situation where the average person may have no way to know whether this oracle provides the price of gold on December the 31st or not. And so, we came to the conclusion that until or unless there's a way to really have very strong confidence in oracles of markets, it really is necessary to use governance to sort of approve markets. So, the token holder governance will allow markets to sort of be checked for fraud and be checked for also the parameters as well. Because the other problem you can do is if you set up the risk modeling for a derivative wrongly, and you don't understand the volatility of that derivative well, or you don't understand how that particular product should be margined, you can create a product where people will be closed out far too quickly. You can create a product where the network itself will lose money because people will owe the network money because you didn't take enough margin. And so you can create a very unstable market. And so again, the community has a role to play in ensuring that sensible markets are created and being able to adjust those parameters later to make them good. So effectively on Vega, you make a proposal. In the first version, the MVP, we have cash settled futures, and you make a proposal providing all the parameters for the futures themselves and the risk models that go in. In future, we'll also have kind of inverting the way that sort of Ethereum models work, where you build your trading system on the smart contract platform. In Vega, we'll actually have almost like a smart contract execution platform within the trading system. So certain modules will be programmable, and the products will be one of those. So you'll effectively be able to design a product in terms of its cash flows, whether it's options or swaps or whatever else. You'll be able to design that and provide a custom product. But initially, it's just cash settled futures. You provide those parameters. You also provide the risk model information. Again, this is kind of just JSON data, so it's super easy to do if you've got good data. You submit that to the system, and it ends up going through a token holder vote. The goal is that the default outcome of that vote is basically you submit it, you voted for it, it will happen. So there'll be a minimum time. So the aim is that by default, markets you sort of submit are going to get created unless the community takes a look and goes, no, this is bad, this isn't good. And so you need enough time elapsed for that. But once that sort of proposal goes through, then the market gets created and it opens on Vega in what we call an opening auction. And this is something that anyone who's dealt with order books and sort of traditional exchanges, especially the ones that close every day, will have seen before, where effectively when the exchange opens each morning, you use an auction to set the price rather than just going straight into a real-time continuous trading mode. We use that to set the initial price on opening of the market, and then the market just sort of enters trading and carries on as normal. So that's really how the process works. And as I said, it's designed to give the community the power to create anything that has demand, and to also build a sort of business case and build for themselves something worthwhile on top of building something on Vega.
Thanks, Barney. Yanwen, can you briefly summarize the process by which positions are liquidated on Perpetual Protocol? And what are some mechanisms that you guys have integrated to facilitate the liquidations?
Yep, absolutely. So basically, we kind of rely on the keepers to liquidate our under collateralized asset. So at the beginning, we have kind of like a basic one, just like what you can see on other protocols. So once kind of like a position is under collateralized, we will like a keeper can go in and then liquidate that. Since we launched, we actually made lots of updates on this mechanism. So we actually add like partial liquidation in April. So partial liquidation actually is a very big update for us. So every time when there is a position that under collateralized, we actually don't really liquidate the whole position. We only liquidate a portion of that, trying to decrease the impact to the whole market. So I think that actually helped a lot. And then we also have this new kind of algorithm that try to calculate the best liquidation price by combining the index price, also the market price. So I think the liquidation now on our Perpetual V1 is really working well. During the last month, actually during May, I think there are lots of volatility in the market, but I think that actually the whole protocol works fine. So the same mechanism will also be implemented in V2, Perpetual V2. So yeah, I'm very confident that we actually have a liquidation system that kind of like on par with centralized exchange like FKX. Yeah.
All right, now one last question. Many individuals perceive exchanges as being inherently competitive with one another. However, decentralized derivatives exchanges occupy a market that is full of great opportunities. What is your take on this ecosystem? And do you believe that each of you will come to occupy your own niche over time or collaborate in some manner over time? Let's have everyone answer briefly because I know we're running out of time now, but let's start with Eric, then Antonio, Barney, and Yenwen.
Yeah, I think this space is growing fast enough, and overall, addressable market is big enough so that everyone has their own niche. We kind of see that for a centralized exchange, infrastructure is that there's always going to be multiple exchanges. Every single exchange has their own niche, has their own use. So I think basically over time, it shouldn't be competitive in nature at all. It should be to the matter where everyone interacts with each other. Everyone has their own take on the exchange model, the product model, and also the futures model. So I think there's a lot of opportunity for us to collaborate and work on even more interesting things. I think just in general, collaboration is always better than competition. And another interesting thing is that, especially as we work towards global margining and, work on something more advanced and cross margining, then the collaboration between these derivative protocols gets more and more important over time.
I think it's certainly quite collaborative right now. Obviously it's a super new space with decentralized exchanges in general, and just growing the entire size of the pie is way better for everyone than sort of just like trying to get more of the pie for, ourselves right now. The other interesting thing that's happening with decentralized exchanges and DeFi in general is everyone's building out in the open, right? And you can see, and we talked about on this panel, just like many different, very technologically different approaches that are being taken by each of us. And I think that's super interesting. And there's a lot of collaboration, just like adoption of best ideas that can continue to happen with people building in DeFi. And I think that's one of the things that's really exciting about the space. It's just the pace of development is so fast because, like I said, everyone's building out in the open. Empirically, we can see the types of things that are working, what Yenwen was talking about, for example, with like seeing that Uniswap was working really well for spot trading and then adopting a lot of those practices into a perp exchange, I think is a good example of that. We continue to be really excited about a lot of the innovations that are happening in the DeFi space really broadly at dYdX, and continue to take a really collaborative approach to building as well.
Yeah, I'd echo what everyone said. I think collaboration is more valuable. Growing the pie and creating value for everyone is always going to beat kind of being incredibly sort of internally focused on a single protocol. I think you'll always have friendly competition. Actually, I think friendly competition where there's an overlap will make us all better. We will see and compete on things that are sort of similar between protocols and build niches where there are differences. And every protocol makes different trade-offs, and every trader and every market needs different things. And so the idea that there's one perfect architecture and one perfect configuration that will rule all markets is kind of nonsense. Actually, if you need composability more than anything else, you're going to pick a protocol that makes composability easiest and fastest and best. If you need performance, you'll do something else. If you need certain types of products, you may pick something else again. And so I think we'll all find the right niches, the right communities, and there will be hopefully a lot of really great collaboration. And as Eric said, once we start thinking about things like global margining and start thinking about protocols actually not between traders or liquidity providers and trading protocols, but actually between trading protocols, where there's a protocol that allows Vega to talk to Injective or Vega to talk to dYdX or whatever, and that gives more value to users, we'll actually see sort of meta protocols, kind of like the early order relaying protocols, 0x and things that we've already seen. I think we'll see the emergence of more and more meta protocols that allow users to get even greater value. So I think collaboration is the key to really cracking this, because really we're all in competition with sexes and we're all in competition with traditional finance. We're all trying to say, let's get rid of this and let's make it more fair and more open. And so if we end up trying to compete with each other, we'll miss out on the bigger prize.
Yep. I totally agree with like everything that everyone just said. One thing I want to add is that Eric and Albert from Injective actually review our white paper. I mean, they are actually the first reviewer. So we are already like collaborating in some ways. So yeah, definitely agree with everyone that is the market is actually so huge that there is no need. Different ways. I think they will find. We will find our own niche in the market.
All right, thanks everyone for sharing your insights with us today, and thanks to our audience for tuning in. It's great to see what these projects here have accomplished so far, and can't wait to see what you all have in store next.
Thanks so much, guys.
Thanks, guys.
Yeah, thanks so much.
Awesome. Thanks, everyone.
Thanks for having me.